Hello there. I hope that you are doing well. Welcome to the masterclass about time cycles. This masterclass is a follow-up to the lecture and thread that I shared about the concept of time-based liquidity and time cycles. If you do not watch or read that content yet, I would highly advise you to do so before diving into this masterclass. However, there's one important thing to note, and that's the following. This masterclass is available to watch for newsletter subscribers between 9 till 12 am. So use your time effectively. Meaning, if you think that you can watch my lecture about the topic or read the thread about the topic later after watching this masterclass, then I would highly advise you to do so just for the sake of scarcity of time. I don't want to waste any of your time, and I also don't want to waste my time. This will be very raw, so that means there will be periods where I might stutter, where I might say stuff wrong and I need to correct myself, or where I need to grab a bottle of water or stuff like that. But it is what it is. I'm not here to waste your time, so let's dive straight into it. Before we begin, I must first give you a very important warning. If you are completely new to ICT concepts, please do not watch this webinar yet. Advanced theory will be shared. And if you try to watch this webinar whilst you are at level 3 in terms of your understanding of price delivery, when the knowledge that will be shared within this webinar or masterclass will be at level 8, you'll have a gap in understanding. And that gap in understanding will lead you to interpret things in the wrong manner. And that's, of course, not ideal. And in order to fix that, you simply need to follow the right structure when it comes to learning. Meaning saying, okay, well, I don't understand the basics yet, so I should not be working on advanced theory. And that's not me saying that you shouldn't ever dive into the concepts that I'm about to share during this masterclass. It just means that you need to be very cautious when it comes to preventing yourself from falling a victim to analysis paralysis. Give yourself time to develop and stop rushing the process. I felt like it is very important to share this warning before beginning the webinar because I would hate to see or hate to hear, in fact, someone reach out to me and say, I don't understand this. And when you look at the charts, they don't even understand what sells out to buys liquidity is, or they even don't even understand market maker models. So, very important warning, and I hope that you listen to that. Secondly, I must give you a risk disclaimer. This webinar is being hosted on the TOTK, the One Said No website, and therefore it's important to note that TOTK is an exclusive educational platform only, meaning that all the content that we share and produce is meant for educational and or entertainment purposes only. I am not a financial advisor. Everything that I will share during this webinar is meant for educational and or entertainment purposes only. If you want to read the full risk disclaimer and all of the documents that apply to our service, you can do so on the onesaidno.com. All right, now that we have gotten that out of the way, let's really begin with this masterclass. So first of all, we're going to take a look at the foundational theory. This foundational theory is basically a repetition of what has already been shared within the lecture and within the thread. We're building on top of this knowledge. So first of all, during the current time cycle, IBDA refers to the previous cycle's highs and lows, meaning that during the current time cycle, we always need to look back at what the previous time cycle or cycles have done. We need to look at their respective highs and lows to determine key liquidity levels. These are algorithmic reference points that are time and price based. To determine institutional order flow, these reference points are crucial. The reason why these reference points are crucial is because these are objective measurements within the delivery of price, meaning IBDA can refer to these levels as either points of interest or draws on liquidity during the current time cycle. This is something that we will discuss later on within this webinar more in depth. I've prepared a whole presentation for you, so we're just gonna go through it together. Time cycles. Let us first take a look at what time cycles there are. First of all, we have a yearly cycle. This is from the 1st of January till the 31st of December. We then have quarterly cycles. These are from, for example, the 1st of January until the 31st of March. And from there on, all of the quarters are important time cycles. Monthly cycles, 1st of January till the 31st of January. Weekly cycles, from Monday to Friday. Daily, meaning previous days. For example, if it's now Wednesday, we look at Tuesday and Monday. Sessions, Asia, London, New York morning, New York afternoon. And within those sessions, we also have 90-minute cycles. Since I am a day trader, my focus is on these lower three, the daily, sessions, and 90-minute cycles. If I would be a swing trader, I would focus on the monthly, weekly, and daily. And if I would be a position trader, I would focus on the yearly, quarterly, and monthly cycles. So what we can already tell here is that based on the type of trader that you are, there are different time cycles that we should be putting emphasis on. This is logical because if you're a swing trader, why would you care about how, for example, the New York session delivered? It doesn't matter. It simply matters, or what simply matters, is how is the higher time frame delivering, and that's why we refer to higher time frame cycles. Doesn't mean that these higher time frame cycles are not important intraday, because based on the higher time frame cycles, the intraday cycles also move. Previous time cycles, their respective high and low, also referred to as PXH and PXL. X being a variable that can be adjusted based on the time cycle that you're looking at price at. Meaning, if you're looking at, for example, let's say the monthly chart, then you can fill in an M here and it becomes previous month's high or previous month's low. If you're looking at session cycles, you can say previous session high, previous session low. Examples of these time cycles' respective highs and lows are the previous yearly high or low, previous day high or low, or previous cycle high and low. Let us take a look at order flow through the lens of time cycles. This is very important to understand because if you do not understand what I'm about to share with you, the remainder of this lecture will not be clear to you. So please pay attention. Order flow can do either one of two things when trading above a PXH, a previous cycle's high, or below a previous cycle's low. What these things are the following. Order flow either reverses or it continues. And you might be wondering, what does that mean, Zeus? What does that mean that order flow can either reverse or continue? Well, pay attention to this. When, for example, price was bullish and we trade above a previous cycle's high, doesn't matter what cycle is, doesn't matter what time window, we see price trade above a previous cycle's high. If we see signs present that price is going to turn around, yes, after trading above that high, then that could mean that price is going to reverse and that order flow is going to change from a buy program into a sell program. However, it is also possible that price is going to continue the buy program after trading above the previous X high and that order flow will continue higher. Even when, for example, price just retraces back into that range of the expansion leg above the previous X high, we still look at that as a reversal. Why? Because order flow has changed for that period in time. That's why I say one or two things can occur. This does not mean that price has to take out previous XH and immediately fall over towards PXL. It just means that we're changing from a buy program to a sell program. and that's change in the state of delivery that's taking place, but that's a topic for another time. So I want to share some chart examples with you of what this looks like when we're simply looking at theory. That's the most important thing I want to share with you as well, is that if you are able to understand theory without looking at real market data, without looking at, for example, real price feeds, without looking at candlesticks, then you know that you are starting to experience light bulb moments. Because when theory makes sense to you, when you're able to understand it without having to see an example of it right away, the light bulb moment is taking place because you've understood the theory behind why something should work in a certain way. But to help you, here are some visual examples of what I'm sharing with you. If we're taking a look at reversals, this is what they look like. This is what the schematics look like. We have a PXL and we have a PXH. We see price trade below PXL, and the moment that price trades below PXL, a warning sign goes off in our minds. This warning sign is important because it is telling us that, okay, be aware now. Price at a crucial point. Let's see what will happen. It will either reverse after purging this sell side liquidity, or sweeping it, I should say. The difference between sweeping and purging is the following. When price trades above a specific high, or it trades, let's use the example of a low because we're now looking at the previous X low. When price trades below a low, a previous X low, or just any low, it's a sweep on liquidity initially. But when we see the signs that confirm a smart money reversal, or a reversal or retracement occurring, we can call that trading below the low a purge on liquidity, meaning liquidity is being purged, long positions are being opened, and the market is now likely to draw towards buy side. However, what is then clearly the difference between a sweep and a purge? Well, the main difference is the following. A sweep is just the fact that price trades below that low. A purge is really the sign that price traded below the low and now shows signs of targeting buy side liquidity. So that's just the difference between a sweep and a purge. I think it's very important for you to note that. So whenever you hear someone speak about sweeps and purge, you now know the difference between the two. But what you see is the following. When price trades below PXL, below that old low, our eye is immediately drawn to the following. Is it going to reverse here, or is it going to continue lower? That's why this warning sign is put here. It's just a sign of, okay, pay attention now. We see price trade above the PXL again, and we now want to see that previous X low begin to function as support. When we begin to see that occur, plus we see our signs of a smart money reversal being in. Not going to discuss them today because that's not the topic of the discussion or of this masterclass. If you want to learn more about that, you can just go on my YouTube, and I have plenty of videos in which I share which signs you could be looking for to confirm a smart money reversal. But when you see those signs be present, and you begin to see that PXL begin to function as support on price, we can anticipate price to draw higher towards buy side liquidity and maybe even towards the previous X high. For the opposite side, it's of course the same. We see price trade above an old high, price sweeps that high, and the moment that we see confirmations of a smart money reversal within a sell model being in play, this is all what leads to one big market maker sell model. This is what all leads to one big market maker buy model. When we see those signs be present of a market maker sell model potentially unfolding, where we see the signatures that we're looking for to confirm that up here, we see the PXH get traded below again. We want to see it function as resistance on price to then continue order flow lower towards sell side liquidity and maybe even the opposite side of the range, which is at PXL. For continuations, the schematic looks like the following. This is the schematic that follows along with bearish continuation. This schematic showcases that price trades below the PXL, it sweeps it, but it never gets above it. In fact, the PXL right here is sort of acting as resistance on price. Price will either look to retrace back into that low and then continue lower, or within this leg right here, it already retraced. Huh? How could it have retraced when it's just down close candles through it? Because on the lower time frame, it's already balanced out. Hidden gem for you there. So what we then see is that the market retraces and it continues lower. This occurs when the market is very bearish and there are higher time frame objectives below current market price that have to be reached. For the opposite side, for the bullish scenario, it's of course the following. Price trades higher, retraces, and we are not seeing price fall below the PXH, so that confirms to us that order flow is bullish. We then continue higher. And what I just whispered there, when it comes to this piece of price action, the breaking through that previous X high, that's so crucial, is because on the lower time frames, sell side delivery can already occur right here, back into that old high to balance that price range and to then continue with higher. When that occurs, when you see those signatures be present, you know that you're in for a very wild ride higher, if your higher time frame objectives have not been met yet. Let me just drink some water because I am noticing that my voice is kind of getting hurt already. Speaking a lot because I don't want to take too much of your precious time, but it's all good. We're 50 minutes in, and it's already like, I'm sure some of you are already like, what? Yep. Just wait until you start seeing it in the charts every single day, every single week. Then the real fun begins. So what we're now going to take a look at is the following. We're going to take a look at time cycles, their highs and lows, functioning as points of interest. And I already briefly discussed this when looking at the reversal scenarios. And what I've done here is I've, of course, put in this warning sign emoji. The reason why I put that in is because the moment that the price trades below PXL, the previous cycle's low, a warning sign should go off in your mind, saying, okay, price is now at a crucial price level or within a crucial price range. We should now look for very specific things to occur to confirm either a reversal from taking place. If that reversal is taking place, it's of course a point of interest that has been reached, or continuation occurring. It's important to note when your higher time frame order flow is bullish, your PXL is of course a point of interest where we could see a fractal smart money reversal form within a market maker buy model to target buy side liquidity later. If our higher time frame order flow is bearish, we would of course be looking at the PXH as a crucial reference point to see price trade above, form a high, smart money reversal within a fractal market maker sell model, and then that high should begin to get broken through, fail to act as support on price, boom, displacement. Then we want to see that high begin to act as resistance again. Then we want to see the opposite side of the range get targeted. I want you to understand that this right here is a market maker buy model scenario on the left side, and this is a market maker sell model scenario on the right side. If you do not understand market maker models yet, I'm sorry, but I warrant you that this lecture would be advanced. However, if you do already understand market maker models, you're probably listening to me speak right now and you're probably smiling because you know that, whoa, you're beginning to connect the dots, so to say. And you're beginning to see how the market moves between time-based liquidity to time-based liquidity during the current time cycle. Time cycles, their highs and low functions as draws on liquidity. Draws on liquidity being from point A, the current price, to point B, which is the PXH or PXL. If bearish, I'm sorry, I do not know why I put now a bearish example on the left side of the screen and a bullish example on the right side of the screen. It has been the other way around throughout the whole presentation so far. My apologies sincerely. I'm sorry, I have OCD, so I can't really deal with those type of small errors, but it is what it is. I hope you don't mind. If it was a recording and I would be able to cut out things, I would just be, pausing the recording right now, switching it up to make it look perfect, and then continue with the masterclass. But of course, trying to make this as raw as possible. So I warned you, this is what it's like sometimes. But what we can see is that from point A right here, the market is drawn towards point B, which is the PXL. As long as that PXL is not taken out yet, we can look for shorts between the price range from point A to point B. If we would be looking for longs, we could go long anywhere in the range between point A to point B. However, it's important to note that the range between the 2 points has to be big enough for you to be, or I should say, for it to be worth it for any risk to get taken. Meaning, there has to be enough room for the market to move. If there's barely any room, it is not worth looking at that. Risk being taken on a demo account, by the way, I'm not telling you to put any risk into the marketplace, because investing and trading carries along huge financial risk, and I'm not a financial advisor. So let us now take a look at 90-minute cycles timings in New York time. The reason why I want to share these timings with you is because, like I said, I'm a day trader. So as a day trader, I need to have crucial reference points throughout the day that I can be looking at in order to define POIs, to define draws and liquidities. Meaning, I need to know what are the current reference points that IBDA will seek to refer to during the current time cycle. And what these time cycles are the following. First of all, for the London session, they are from 2:30 a.m. to 4 a.m. Secondly, we're looking at 4 a.m. till 5:30 a.m. And thirdly, looking at 5:30 a.m. till 7 a.m. One thing that's important to note, like I already mentioned within the YouTube lecture about this topic, is the fact that the 90-minute cycles during the London session seem to have less impact on the delivery of price than during the New York morning and afternoon session, especially on the index futures. So for London, you're probably better off by referring back to the Asia session or back to the previous day's PM session or morning session to define crucial reference points during the London session. Something for you to investigate, but I think it's important for me to share that. Doesn't mean that these cycles don't hold any value, because if you would study the delivery during London, between these time windows, you would see very precise things occur. For the New York morning session, the time cycles are as follows: 7 a.m. till 8:30 a.m., 8:30 a.m. till 10 a.m., and 10 a.m. till 11:30 a.m. For the afternoon session, the cycles are as follows: from 11:30 a.m. till 1 p.m., from 1 p.m. until 2:30 p.m., and from 2:30 p.m. till 4 p.m. Now, before we continue, I want you to note that each time that, for example, the first cycle ends and a new cycle opens up, so the second cycle opens up, a new function, so to say, is taking place. And it all has to do with AMD: accumulation, manipulation, distribution, power of 3. During the first time cycle, the range that is being established is the accumulation range. During the second time cycle, the range that's being established is the manipulation range. During the third cycle, the range that's being established is the distribution range. This occurs for all different sessions. 3 different sessions, 3 different phases. AMD: accumulation, manipulation, distribution. Very important for you to study. Preferably, we want to see highs or lows form during manipulation or distribution windows. However, what's important to note here is that if, for example, a high or low would form every single day between, for example, 4 to 5:30 or 8:30 to 10 or 1 to 2:30, it would of course be too obvious what would be going on from a algorithmic stance, from a coder stance, from a, how to say it, from a higher level stance. Because you need to understand this, these people that are in control of these markets, that are in control of the algorithms that are delivering price, they need to hide their business, so to say. The system that they have in place has been here for centuries. Yeah, it first used to be done by hand, meaning manually, but when everything was digitalized, they switched to algorithms. How can you make, for example, a delivery program so efficient, so perfect, but at the same time make it look like the markets are random by switching up at times when certain things happen? So what does that automatically mean? It means that time cycles, their respective functions, shift each day. This day, the higher low will form between that window. That day, the higher low will form between that window. And so you can continue. So our job is to determine what is the current delivery profile for either the day or session. And one thing I want to share with you is that within these cycles, within these 90-minute cycles, within these time windows, you can fractalize the function of AMD all the way down. During this webinar, I will not discuss how to fractalize the cycles down. I'm going to keep that exclusive for the ones that know within the respective time PDFs or ebooks that have been created for them. And during the live streams that we held about the topic of time, we've discussed this as well. And I will leave it up to you to figure out how you can fractalize these cycles, because it can be very powerful when used properly. So let us now take a look at a chart example. And before we begin with this chart example, I first want to share with you the following. All of the charts that I will share during this presentation are either deliveries in which I executed myself, or in which students of mine have executed the logic that I have taught them. I do not like people that just share theory that only seems to work in hindsight and do not have any proof of them being able to utilize that theory within a live environment. Whenever you see someone do that, always question their validity and question especially the validity behind the things that they're sharing. Because if someone would be able to utilize the theory that they're sharing with you, why are they not sharing that they can utilize it? Think about that for a second. So here we are on the 21st of March 2024 during the PM session, the afternoon session. I took a short here. This is on the NASDAQ for your info. You can go on my Twitter profile and you can see the execution video. And before I begin breaking down this trade, utilizing the logic that I've been describing to you so far during this presentation, I want to give you around, let's say, 10 to 15 seconds to just take a look at this chart and think about it yourself. I'm just going to mute my microphone, so please take some time to analyze what you see. You, of course, can't really make any annotations, but just try as best as possible. Good luck. All right, so those were around 10 seconds. I hope that you were able to look at this price action and make it a bit clearer for yourself. I'm now going to skip through to the next slide of this presentation. So keep this delivery in mind, and now I'm going to add some lipstick to it. What I've done with this lipstick is the following. First of all, I have added the 90-minute cycles, their respective opening times, by showcasing their opening times with a vertical line, as can be seen here. I've put vertical lines at 10 a.m., 11:30 a.m. and 1 p.m. Next to that, I have annotated the respective highs and lows of these time windows. Why did I do that? Because those levels are crucial reference points, as I've been sharing so far during this lecture. What we can see is that from around 11:30 a.m., the market begins to expand higher. Notice that it trades above this high. Why is this high so important? This high is so important because it is the high of the time window of 10 to 11:30 a.m. The market expands above that, but it doesn't reverse just yet. Why doesn't it reverse just yet? Because there's another premium price level that it could trade towards. What's that premium price level? It's the open of this down close candle to the high of that down close candle. It's a bearish rejection block. The market trades into that, and at 12:30 the market begins to show signs of reversing. One thing I want to note before we dive into the sell side of the curve is the fact that on this buy side of the curve, we need to take a close look at when it began, when that buy side of the curve actually started, so to say. What we see is that from 10 a.m. on, the market expands higher. The function of this expansion higher is the following: it traps people into believing that higher prices are going to be next now. People go long here and they place their stops below the lows right here. They're engineering sell side liquidity. The market distributes aggressively lower, it manipulates lower below the low that formed prior to 10 a.m. to the previous cycle's low, because we know that 8:30 to 10 is a 90-minute time window or 90-minute cycle. Market trades below that old low multiple times, and then between 11 to 11:30 the market finally forms the real low here and it begins to expand higher. What we then see is that from 12:30 on, a sell program begins. Why does the sell program begin when the market didn't trade above this high yet? We will touch on that very soon. But the market displaces lower, it distributes lower, and we begin to see bearish premium rays begin to act as resistance on price. There's multiple taps into the CB, but the market respects it perfectly. At 1 p.m., the market opens up and it immediately distributes aggressively lower. What does this signal to us? It signals that bearish institutional order flow is present, and something very specific is happening that I will probably, I'll share it with you. I was just thinking whether or not I should share that, but fuck it. So the market displaces aggressively lower through a specific price level with a CB right here. Market retraces into that CB. Look at the bodies respecting CE 50%, consequent encroachment of that CB. Market displaces lower again with a new CB. Market again respects CE 50% of that CB perfectly, and it displaces lower again. New CB gets created. Look at the bodies respecting the low of that CB. That right there is an algorithmic signature that is screaming lower prices. But now comes something even more important. And that's the fact that when price displaces lower here again, a new CB gets created. Market retraces into that CB, forms a high. Exactly 1:45 p.m., which is a crucial time. My mentorship students know why that's a crucial time. Same applies for the high that formed in this area. There are times when the market is allowed to expand or reverse, and those macros, so to say, are very important. So what happens here is that the market retraces, and it retraces into the previous cycle's candle right here, previous cycle's low. The low is right here at exactly 11:30. Look at how the market respected the high right here. Apologies, I went too quickly there. We'll touch on those two markets in a bit. But it retraced all the way into the high of this candle right here, the candle that formed the low of the previous cycle. Go into your own charts and study the perfection right here. And the market respects that high of this candle perfectly with the closes. That signals continuation. When price trades below a previous X low, we look at how price is reacting to that old low, and specifically the candle of that old low. And that is why I'm referring to this candle as being crucial. Within my execution video, you can actually see me annotate it. I initially had this down close candle annotated. I didn't look closely, but then when I realized I had the wrong candle annotated, I annotated the proper one right here. Market then distributes lower aggressively. and it trades below the low of the 10 to 11:30 time window, which is the third AM cycle's low. Eventually, the market retraces into this down close candle and it continues lower again. Now, back to the topic of why the market did not take out this high right here. You probably already guessed it because I just accidentally pressed on the button to show the next slide. But we're going to take a look at intermarket relationship. But before we do so, I must first share with you why this 1 p.m. opening was so crucial. This 1 p.m. opening, yeah, it displaced through 50% of the previous cycle's range midpoint. What? What did you just share? I will leave that open to you to investigate. If you measure the low to high of that range, of the previous cycle's range, and you apply equilibrium to that range, you can see very funky stuff. We'll touch on it more later during the presentation. So what we see here is that on the left side we have the Nasdaq chart, on the right side we have the ES chart. And I'm just going to give you a second to take a look at these charts, and I want you to pay close attention to what is occurring on the highs. Again, I will give you around 5 to 10 seconds to take a close look before continuing with the presentation. All right, I trust that you have taken a close look to the highs, and for the viewers that are paying attention, you have probably already noticed the fact that Nasdaq created lower highs right here, whilst ES created higher highs. And you might be wondering, why is that significant, Zeus? Why are we paying attention to that? Well, if you have a good understanding of market maker models, you understand that one of the main things that we can do to confirm a smart money reversal is take a look at intermarket relationship. Note that this is confirming an idea, meaning we already need to have established a delivery profile, and then the smart money reversal simply functions as a confirmation of this being the case. So what we see is that Nasdaq creates lower highs whilst ES creates higher highs. If we apply time to this, we will see that there's SMT that is taking place during the current time cycle relative to the previous time cycle. Yep, there are multiple ways of there are multiple ways of detecting SMTs. Simply a cracking correlation by itself is just one way. Taking a look at a cracking correlation relative to previous cycles, their respective highs or lows, is another way. So what we can see is that Nasdaq's AM high formed right here, whilst ES's AM high formed right here. During the PM session, Nasdaq failed to trade above the AM session's high, the morning session's high, whilst ES did. So it means that ES swooped the high. This is a turtle swoop that's taking place, annotated with this red box, whilst Nasdaq does not, and then the market is allowed to expand, or reverse, I should say, and expand lower. Notice that Nasdaq was the weaker market, and that's why Nasdaq was also more volatile when it comes to delivery. Next breakdown is of the PM session of the 12th of March 2024. Instead of looking at the 21st, we're now going to take a look at the opposite numbers. So again, the numbers 1, 2 coming back. I'm going to mute myself again for around 10 to 15 seconds. And I want you to take a close look to the delivery that occurred right here. And I want you to pay close attention to the x-axis right here, which is where time is at. And I want you to take a look at the price patterns that are occurring during very specific times. Good luck, and I'll speak to you soon. All right, I trust that you have taken a close look to this delivery and that you have deciphered it as best as possible to your understanding. I'm going to again add lipstick to this chart, and then I'm going to break it down for you. So what you can see is the following. I've annotated again the crucial opening times, 11:30 to 1 and 1 to 2:30. These are important times because these are of course the opening times of our 90-minute cycles. What we can see is that from 11:30 to 1, the PM cycle begins. This is the first PM cycle. So that means that this high right here, which formed right before 11:30, is the morning session's high. Now it's important to note that the higher time frame context here was that we were expecting higher prices. We were bullish. Ever since basically the first week of January, we were expecting higher prices for the index futures. This is the Nasdaq chart for your info. Again, the recording, by the way, of this trade can be found on my Twitter. So what we were basically looking for throughout all of the reviews was the following: higher prices intraday, especially during this week. So when we then saw the market stop right here, and then at 11:30 immediately have this big down close candle lower, displacement lower, it's a sign. You need to look at this right here as if they're tipping their hand to you. They're saying literally to you, we're going to manipulate it lower to distribute it higher at a later point in time. So it means this is the sell side of the curve right here that's taking place, and this is the buy side of the curve. The whole function of the first PM cycle was to simply trap people into believing that the lower prices were next for the afternoon session. The lower highs are being made. What does that mean? Retail Rick looks at that and they're thinking, okay, we're gonna see lower prices now for the afternoon session. What occurs is the following. The second 90-minute cycle of the PM session comes along. What do we see? The market opens up, trades higher, and then immediately manipulates lower. Now notice that no lower low is being created relative to that previous cycle's low. We're going to touch that again soon to discover why that was the case. Market displaces to the upside. Now notice that the gaps are being allowed to stay open. This is screaming bullish institutional order flow. Market displaces above this high, but more importantly, it displaces above this high right here. Why, oh why is this high so important? Pay close attention to time and what I told you about the cycles being fractal. 12:30 to 1, 90 minutes, divided into 3. What's the final 30-minute window then? 12:30 to 1, that high is important during the next 30-minute window. Fun, isn't? Fun, isn't it? That fractal theory. Market displaces above this high. Now notice that this retracement leg or this consolidation is acting as support on the right side of the curve. It's perfect market maker buy model. Market retraces into this BC here, forms a low. Time distortion is taking place. Why is time distortion taking place? Because the time wasn't right yet for the market to be allowed to expand higher. Market manipulates lower during a key time window, but notice that it doesn't displace below this low. Why is that important? Because this low formed at the right time, making this close to the low a bullish rejection block. And when we see price respect that rejection block, displays to the upside, I went long inside of the retracement into this BC, anticipating the market to draw higher towards the previous cycle's high, which was here, which was exactly, or I should say nearly exactly the same high as the AM high. And we see perfect bullish institutional order flow where every single retracement is being bought up by smart money to make price expand. Now, of course, I say it's being bought up by smart money. I'm not saying that buying or selling pressure moves these markets because we know for a fact that it doesn't. However, it's just important to note that every single retracement is being bought up by smart money. This is not the reason why price is allowed to expand higher because we know that this is driven by algorithms. So here we can take a look at the Nasdaq chart on the left side and the Dixie chart on the right side. And we're going to take a look at the lows on Nasdaq relative to the previous cycle's low and the highs on Dixie relative to not the previous cycle's high, because that high, so the high between 11:30 to 1 was higher than this high, but we're taking specifically a look at the fractal cycle, the fractal 30-minute cycle. So the 12:30 to 1 slow on Nasdaq right here, and the 12:30 to 1 high on Dixie. What we can see is that Dixie created a higher high relative to that cycle during the next 30-minute window, whilst Nasdaq created a higher low. This is SMT, and this signals to us that a smart money reversal is likely to take place now. When we then see this displacement higher, it confirms it to us. Apologies, let me drink some water. All right, so here you can see me having annotated a big fat red line on my chart. And you're probably wondering, what is this big fat red line? Well, this big fat red line is what I was debating whether or not I should share during that initial breakdown on the 21st PM session. But this big fat red line represents equilibrium, or the range midpoint of the 11:30 to 1 time window. Meaning, what I've done is that I've measured from this high to low, equilibrium, range midpoint, and I've extended that line on my chart all the way through to the next 90-minute cycle from 1 to 2:30 PM. And as you can see, price displaced above that level, retraced below it into a discount BC here, discount relative to the real dealing range. No, I'm not going to touch on that today because we're focusing on time cycles, but price retraces into a discount of the real dealing range. Market again goes sideways. Time distortion is taking place because time and price need to be aligned, meaning the right patterns in price can only be occurring during the right time windows. So, and secondly, what's important to note is that we know that within every single range, whether it be timed ranges or price ranges, consolidation takes place around 50%, meaning that the market usually goes sideways during those 50% levels, so to say. And that's what we see here as well. If we would study the delivery on the left side of the curve already, we can see that this is a crucial price level simply because of all of the times that price closes around that price level and it refers to that price level. But also on the right side of the curve here, where we can see that time distortion take place. And when the time is right and the market shows a willingness to move away from it with speed and velocity, it's like the elephant jumping into the room, we know that order flow is bullish, and then we can get in line with the IPDA, basically the interbank price delivery algorithm, and we can benefit from this run higher like I did within my execution video. So here we are again on a blank chart. I'm going to kindly request you to take a good look at this chart for around 10 to 15 seconds. I'm going to mute myself again, so good luck. Alright, I hope that you have taken a good look at this chart and that you have analyzed it as best as possible. I'm going to, first of all, share with you something from the ones that know, our exclusive trading community, because I personally did not participate in this whole delivery right here. However, I just want to show to you that some of my students did, and therefore I feel like this is a valid example still to showcase, simply because people that utilize the logic that we teach have taken trades within this environment. Simply shows that what we're doing repeats and it works. So first of all, we have a message from AJ Trades NQ. He said, "I've learned so much, yo, got no idea, haha." And what we can see, he went long right here at this price level. Stop loss was below this low, anticipating buy side liquidity to be this raw. And he probably also took a partial above this high, which was the previous cycle's high within a 30-minute window. Here we can see Frank, who also took a trade in that area. He went long even lower. He went long at this price level, targeting buy side liquidity as well. Here we can see Colorado huge who went long later in the delivery at a later point in time, who benefited from this run higher. Let us now take a look at the chart and break it down. This was by no means the most cleanest delivery, but it's still good delivery to basically look at and decipher. So what we have done again is we have plotted vertical lines at the 11:30, 1 p.m. and 2:30 times, and there's probably too much annotated for you, but just gonna walk it, or I'm just going to walk you through it step by step. So please do not be worried. First of all, we're going to take a look at 11:30. From 11:30 on, sell side delivery occurred. We can see that the market is being repriced lower. It's expanding lower. It's by no means a clean expansion, but the market is expanding lower. At 1 p.m., the market then has this big upclose candle and it begins to show signs of reversing. Yeah. We are seeing SMT with ES take place right before that 1 p.m. opening. The low on Nasdaq forms exactly at the right time. Market begins to displace higher. It trades above this candle's high right here with this wick. And a BC is left behind. So market retraces, institutional order flow, entry drills taking place here, IOFET, boom, there it goes. Market retraces again into what? Into the high of this down close candle right here. Forms a low, expands higher, trades above range midpoint, and notice that again time distortion is taking place, consolidation. Market expands higher, forms a high, manipulates lower, taking out all of the sell side liquidity engineered within this consolidation, within this time distortion. And we see a low form again in that candle's high. Now, you might be wondering, why is this candle, this down close candle, so important? I've already annotated a lot, so to the people that are paying real attention, already have a high level of understanding. They're looking at this and they're probably smiling because they know what I'm hinting at. But let me just walk you through it. What we see is that the market expands lower. We form a low here. Market 10 forms a high, lower low. Yeah, this low gets formed, and the market then utilizes this low to expand higher right here. What does this down close candle then become? When we see this high getting taken out. It's the pattern of a bearish breaker, right? Especially when this down close candle gets broken through with a CB. Yeah. But why would the pattern of a bearish breaker, where we see a low, high, lower low, higher high, form, be significant on the right side of the curve? It's because this is an inverted breaker, meaning this candle is a crucial reference point on the right side of the curve to basically gouge order flow. And what makes this candle even more significant is the fact that it was the low between the 12 to 12:30 time window. Hey, yep, again, we're utilizing the 30-minute cycle logic to basically determine crucial highs and lows. And I know that as a swing trader, you might be looking at this and you're like, how could this be of use to me? How could I even utilize this information? Have you ever thought about the possibility of this all being fractal and this all occurring in one another? So we see the market form a low here, right here, and it begins to expand higher, taking out buy side liquidity, forming the high of that second 90-minute cycle of the PM session. Market retraces all the way right here into this down close candle, forms a low, and it then trades higher. Now notice that it stops right before the 11:30 opening, and it forms relatively equal highs right here during that final 90-minute cycle of the PM session. Around The end of the day, the market takes out that engineered buys liquidity and trades into the opening price of 11:30. Notice that the market never trades above the 11:30 high. Why not? Because the function of this PM session was to consolidate. The job was already done between 11:30 to 1 when it comes to the sell side delivery, and therefore the market was stuck inside the range from this high to this low. When it occurs, you see this type of price action when there's a lot of back and forth going. Main takeaways from this breakdown are, first of all, range midpoint being very important. Important price level to study. Just study how price moves around that price level, how it distorts time, how it consolidates. And secondly, this is also very important to study. So, damn, I believe we're already nearly an hour into this masterclass. And I think I've timed it pretty properly because I was aiming for an hour. So, yeah, I hope that you already learned a lot. If you want to get access to my universal time and price trading models, in which I make use of all of the information that was shared during this lecture, you can get access to those in my mentorship. The link to that is below the video player on this website. I want to share with you as well that you might feel overwhelmed by everything that was shared within this about an hour long webinar. And that's completely normal. That's completely understandable. However, if you feel like you need way more information and way more basically explanation on all of the topics that I discussed during this webinar, you can find that within this series, which I call the model series, in which I'm literally just opening my brain and sharing all of my insights when it comes to utilizing these concepts day in, day out, week in, week out. And next to that, you also get access to all of my day reviews and weekly reviews and trade breakdowns, in which you can see me apply all of this logic within a live environment. So I want to thank you for basically watching this webinar all the way to the end. I know it was a long sit probably. I hope that you found it insightful. I did my best to try and make it as easy as possible for you to understand. I did, however, warn you that I would discuss advanced theory. So if your brain is fried right now, that's a good sign. It means that you have unlocked new things, or at least new things to think about. If you want to stay in touch with me, you can follow me on X on the @Zeussy_MMXM. If you want to join the ones that know my exclusive trading community, you can do so through this website. In that group, you are able to connect with like-minded individuals and people that apply this logic live day in, day out. Meaning, if you want to learn basically how people are able to utilize all of the information that was shared during this webinar, this is where you can do so. And finally, if you want to look at more lectures of mine, you can do so by going to my YouTube channel, which is named Zeussy. And of course, you can check out my mentorship if you want to get access to mentorship quality, lectures, and breakdowns and reviews. I want to thank you again for watching this webinar all the way to the end. I hope that you are going to make proper use of this knowledge. Please do not go out there and do stupid things. Again, everything that I shared was meant for educational and/or entertainment purposes only, and I wish you all the best. Be safe.